Okay, so today's video, the topic is going to be interest rates. I know I have touched on in the past in several videos about how interest rates affect your loans and things like that, but today I want to dive into the topic of when the statement is made that the feds are going to raise the rates. What does that mean? So indirectly, it means directly it doesn't affect you directly, but indirectly it does affect you. It affects any time you borrow money, such as credit cards, uh, vehicle loans, things like that. Credit cards and any type of non-fixed interest rates are going to be affected more. So the reason that is because they're not fixed. They can be adjusted at any given time. So currently, in the last couple of years, interest rates have gone up quite a bit from where they were in 2008-9 time frame when rates were low. So I'm going to give an example of how interest rates are utilized. And this is the video I said about why do I pay interest. This is how and why banks lend money. So in a traditional standpoint, and I'm going to use banks because I'm tired of saying financial institutions. So traditionally, back in, well, forever, the way that banks made money is they took in your deposits and they made loans. I obviously can't write to the right. On the deposits, they would pay a percentage for you to keep your money in their bank. Let's say they pay 0.25%. And I know that's pretty high for nowadays. But then they would turn around and they would borrow that money to someone else or lend that money to someone else at, let's say, 3%. So what they call the spread is the difference between the price that they get for when they lend it and the price that they have to pay. So in this case, the spread is 2.75%. Now today, it's a little different, and it's been different for a few years. So again, this is traditionally how banks made money on the money. Fast forward a few years, and now I'm going to move this because it's not comfortable writing the other way. So now the way that banks make money, they still take in deposits and they still make loans, and they still collect that spread. Let's say let's 2.75%. Okay. The problem is we need more money than we can get deposits at any one given bank. So a bank in Los Angeles has no problem getting deposits, but a bank in Des Moines, Iowa, let's say, and I'm just using those cities for instance, could have more loans than they have deposits. So enter in the federal government. So the federal government, or Federal Reserve, will lend money to the banks. So now they are, let's say, the depositor. So this is the Fed. So the Fed's price of money is a lot more expensive. Currently, right now, for a 5-year, and this was as of yesterday or the day before, a 5-year fixed rate from the Federal Home Loan Bank was 3%. Now, they're going to lend that money. And what they try and do is match up. So this is for 5 years. What they try and do is match this rate with a loan term. So if they get a car loan for 5 years, those two should work out perfectly. And let's say that car loan is 4%. They're going to get the margin on that, which is basically 0.97% on that money for 5 years. And that's kind of how they try and structure their loans. Now, some of these loans aren't going to go all the way 5 years, so they'll have to re-lend that money to someone else to kind of keep that margin, to keep that spread. But you can see, this is why banks like deposit money a lot better than borrowed money, because the margins are so much better. So if you notice lately, with interest rates going up on loans, you also see a lot of higher interest rates on deposits, especially online banks that do not have the overhead that brick and mortar banks do. So this is kind of a very broad explanation of how lending works nowadays. Now, back to the topic of the Federal Reserve. So the term prime interest rate, the definition of that is the best rate you would give your best borrower on any given day. And they take a consensus of all the banks in the entire United States, and that's how they come up with that interest rate. Currently, the prime interest rate is 5%. It was 4.25% last year at this time. So we're looking about 0.75% increase in 1 year. And I think what they're looking at is another 0.5% before the end of the year, and possibly some next year. How that affects you is most, not all, revolving debt, such as credit cards or lines of credit, things like that, are tied to an index which is prime, which is the Wall Street Journal Prime. Every day in the Wall Street Journal, they publish the prime interest rate. Your current credit card that you have, let's say the rate is 10%, and I know that's a very low interest rate for most credit cards. So prime is 5%, which means the margin is prime plus 5% to get 10%. So every time prime goes up, your credit card interest rate goes up. Again, last year, your credit card was probably 9.25%. And it'll continue to keep going up and following that index. Now, the misconception is that the Federal Reserve raises the prime rate. And that's not true. The Federal Reserve raises what they call short-term borrowing rates, which that will be a complete other topic, and if you're really interested in interest rates and how money works that way, watch that video coming soon. But it's very directly correlated with prime rate. So at the next meeting, which I believe is in September, 23rd, 24th, 25th, if the Federal Reserve decides to raise interest rates by a quarter percent, or quarter or 0.5%, you're going to see prime go up the next day. Because that consensus among all those banks in the United States is that now that our borrowing costs are going up, we have to increase our lending costs. Prime interest rate moves a lot faster than what you call your traditional 30-year fixed rate mortgages or your secondary market mortgages, which I can go into that in another video also. But the reason being, these companies that buy these, Fannie Mae, Freddie Mac, those types of, it's an investment for them. So they are taking other funds, pooling it together, and investing in it. So those rates don't go up as fast as prime does. 2.5, 3 years ago, prime was 3.25. So you can see over 2 years, it made a big difference. So that's just a basic, again, top-level view of interest rates. And I would love to answer other questions if you have any. Hopefully this maybe spurred some. Again, not every variable rate interest rate is tied to prime, but a majority of your credit cards, lines of credit, those types of things are tied to prime. So I hope you enjoyed this video, and I look forward to making another one. If you have any comments or questions or concerns or critiques, please let them below. and have a great day.